Ladies and gentlemen, Bitcoin is rallying over the last week or so, but in the last 24 hours, Bitcoin has went from approximately $77,000 up to $80,000, almost $200 per coin. Now, this is a great sign for risk on assets heading into this week. As you can see from the futures market, the Dow is currently up 0.5%, S&P's up 1/3%, but the Nasdaq is struggling, only up 0.01%. Now, we do not have Russell 2000 futures here, but I imagine the Russell is up around 0.5% to 1% as well. And I have to be honest, what I'm seeing on X over the past 2 days or so is a lot of pushback to this rally that we've seen. A lot of people try to say the markets are overvalued and this rally is not justified. And to a certain extent, that is true. If you look at the headline S&P, it's a little stretched. If you look at Big Tech or Mag 7, it's a little stretched. But that's not the area that I'm bullish on. That's not where I think the opportunity is. I think this is probably one of the best charts to put this into a little bit of perspective. Mega cap tech is trading at 28.5 times next year's earnings, S&P at 22.2 times next year's earnings, mid caps at 16.8 times next year's earnings, and small caps at 16.7 times next year's earnings. Just to even get back to where we were in like 2018, you could see small cap earnings get back to about 20 times next year. You could see mid cap get back to about 18 times next year's earnings. And you're not trading at historically rich levels. I mean, you're trading at the same levels that you were at in 2010. In the later part of 2009. You're not overstretched in some areas of our markets. And that is where you could start to see some of the catch up, as we are seeing even now in futures, with the Dow that's outperforming, with the Russell that is presumably also outperforming. AKA, risk on assets are likely to outperform from this point on. I don't think Mag 7 is going to keep up with the Dow or the Russell or some more economically sensitive areas. And this is exactly what I've talked about for months now here on this channel. With that said, ladies and gentlemen, we do have some big events this week with economic data as well as earnings, and I will also share those with you. Because people right now are fishing for a reason to be negative. If you want to be negative, it's easy to find a reason, specifically valuations. But again, if you just look at the headline market, then it's easy to make that argument. It's harder to make the argument for the rest of the markets, aka a broadening kind of rally. Seth Golden on X writes, forget the Fed put. Does Powell own calls? Fed is cutting into the greatest trailing 12-month return and forward 12-month PE in history. You've never seen a stronger market that the Fed has cut into. And you have some on X like Sven Hendrick that says the cumulative advanced decline line makes a lower high on new SPX highs, suggesting that this is a sign of some kind of reversal that is coming. But in fact, as Seth Golden writes on X, last week, more than 14% of NASDAQ stocks made a 52-week high. Remember, the NASDAQ has a lot of garbage in its growth construct, hence A/D line is not a good measure of its breadth. So when we see this kind of breadth strength, we look to identify its likeliness in the past. Historically, such breadth has not marked the peak in any NASDAQ bull cycle since 2002's cyclical bull market. He also points out that consolidation periods are normal and to be expected. And when you look at this kind of breadth in the NASDAQ with the percent of members hitting a new 52-week high, whenever you get these big breadth thrusts, they tend to lead to stronger markets, not weaker markets. But I'm kind of under the same opinion as someone like a Tom Lee that says, yeah, sure, there's maybe some opportunity in big tech or some areas of our markets, but the real opportunity is small caps. It's in cyclicals, industrials. It's in a broadening of this market rally. In fact, you could see big tech sell off and the rest of the markets rally higher, that would be great for a stock picker, like perhaps yourself. But it wouldn't do much to help out the headline S&P or the NASDAQ. You might still see the NASDAQ fall because of the extreme weightings that you see in big tech. And the markets are all built on forward expectations. So if we all expect or come to expect earnings growth will broaden out to larger areas of our markets, and perhaps big tech looks a little less attractive based on a growth of earnings kind of comparable, then that becomes a problem for the headline S&P. At some point, I expect this to happen. Meaning, if big tech is growing earnings at 10%, Apple's growing earnings at like 5%, right? But the rest of the markets start to grow earnings at 11, 12% or more, then why would you own big tech growing at 10 times, whereas the rest of the markets could perhaps grow at 11 or 12 times? And I think it's as simple as the stocks that offer the most growth are going to start seeing the most attention. This could be Tesla within the big tech camp. It could be Nvidia if that growth continues, but a lot of other big tech names are not going to look like a standout compared to the last 2 years where big tech has been the only area that has grown earnings. The bar is a lot lower for the rest of the markets. Just like this last earnings season, the bar was really low for everyone. And everyone pretty much did well because the bar was low. Now think about this in context of the broader markets. Big tech has done very well. So it's going to be harder for them to grow more than the rest of the markets, whereas the rest of the markets really haven't grown earnings in the past couple of years. So now if they're able to post some impressive numbers, that looks really good from a growth perspective. It also makes it a little easier to justify some of the current valuations. With that said, the percent of stocks currently trading above their 50-day moving average is at 67.3%. Yeah, that's good, but you're not in extreme territory like you were to start 2024 when about 86% of stocks were above their 50-day moving average. So there's definitely some room here for a broader, more inclusive rally in markets. The CNN Fear and Greed Index is also at 61. On Friday, it was at 59. So you're barely in greed. The markets are kind of neutral overall, and I would argue the sentiment that you are seeing on social media, like X for an example, is more bearish than bullish. I'm seeing a lot of people that are really rejecting this latest rally, and bull markets, they grow on pessimism. They die on optimism or euphoria. And it sounds like you're still in the pessimistic phase of this rally. And yes, as I've said before here on this channel, I do believe at some point over the next couple of months, we will have a growth concern. We will have a growth scare when the data starts to turn more negative, and that will cause a correction. Yes, that will happen. Corrections can still happen. I know it sounds crazy, but corrections can happen. And I expect one will happen, and that will be another great buying opportunity as long as we don't start to slip into more recessionary like times. And I don't expect that's going to happen. It's a possibility and we don't know for certain. I'm not going to throw in the towel here and say we have a soft landing because it's just too soon to know that. But the odds definitely tilted in our favor, I believe, when Trump became president. The last thing he's going to want or try to do is create bad policies for the economy and drive us into a recession. Like, that's not what he got elected to try to do. For an example, if a tariff policy is going to have a very negative impact on the US economy, it will not be done. I believe the tariffs that you will see will be minor in nature and really not have a huge economic impact. I believe inflation will be lower, as I stated in the last video. Inflation will fall faster than expected, and you will see treasury yields come down, and that could actually help offset some of maybe bad tariff policies if there's more accommodation from the Fed. That said, I'm only trying to predict tailwind events or tail risk events. That means good positive outcomes to the economy, in which I think we're kind of pricing in or expecting, I guess mentally, worse than what we could actually see. Just go on CNBC and look at anyone talking about tariffs or inflationary pressures via tariffs, and it's everywhere. That's all you hear about. But if that doesn't happen, that's another big tailwind for markets. Now, with that said, let's go over some of the earnings for this upcoming week. On Monday, you don't really have many notable names, so I'll just leave that there. Screenshot this if you would like to, or go to Earnings Whispers on X. Tuesday, you have Shopify pre-market, Plug Power, Home Depot, C, Hertz, Sonova, and others. Specifically, Home Depot will be important. Any companies that are really largely consumer-based will be important because the consumer has not been doing that great, especially on the low-end side. If you get some kind of pocket of strength that starts to emerge, that's something I will be watching for. Now, Tuesday and after hours, you have SoundHound, Marathon, Digital, Cava, Spotify, Oxy, Biostem, and Rocket Mortgage, as well as Instacart and a couple of others. Wednesday pre-market, you have Hut 8, CyberArk, Tower Semiconductor, and some others. Wednesday and after hours, you have Cisco, D-Local, Color, BioNano Genomics, that's a Kathy Wood play, or at least it was. Thursday pre-market, Walt Disney, Intuitive Machines, JD.com, Nice, Advanced Auto Parts, Billy Buy, and a couple of others. Thursday and after hours, you have Applied Materials, AST Spacemobile, interesting sounding company there. And Friday pre-market, you have Alibaba. As far as economic data for this week, you don't have anything on Monday to be concerned with. On Tuesday, you have some data coming out for Europe, but we're not going to focus on that. You have a speech from Fed Waller at 11 o'clock in the morning, Fed Barkin at 11:15. Consumer inflation expectations, expecting that to come in at 3% around noon. And you do have the RCM TIPP Economic Optimism Survey, expecting that at about 11:10 in the morning as well. Couple of Fed speakers throughout the day and in after hours as well on Tuesday. Wednesday is going to be the big catalyst. Core inflation month over month expected at 0.3%. There's a risk, or a chance, I should say, not a risk, but a chance that comes in a little bit on the lower side. That would be great to help support this market. Core year over year expected at 3.3%. These are unchanged numbers from last month. And headline inflation month over month expected 0.2%, the same as last month. But year over year inflation expected to pick up from 2.4% up to 2.6%. None of this would be a huge problem, but definitely something to be watching for. If we do see a much hotter than expected inflation report, that would be a little bit more of a cause for concern. Now, you also get a bunch of Fed speakers on Wednesday throughout the day, but you get total household debt that comes out at noon, and kind of adverse to what you would think. More debt, the more the markets will likely, like it, right? More debt is seen as good because that means more people are spending. Now, Thursday, you will get PPI month over month expecting 0.2%. Last month was 0.1%. And these inflation numbers, I believe, will come in a little bit lower than expected. It's not going to be a huge, miss, right? But I think it will be lower than expected. Initial jobless claims will come in Thursday at about 8:30 in the morning, like they always do. Expecting about 222,000. Last week was 221,000. So the lower, the better there. You also have a speech again from Fed Jerome Powell. So that's something to be watching for Thursday at, looks like about 3 p.m. That'll be a big catalyst for markets. Bunch of data out of China as well. Bunch of data out Friday in the morning from Europe. Bunch of GDP data, economic data from the UK as well as Germany, I believe there. Friday, you will get retail sales month over month. Last month, you were positive 0.4%. You're expecting positive 0.3%, so that's pretty good. Export prices expected to fall marginally, as well as import prices. You will get New York Empire State Manufacturing Index, expecting that to get way better, from negative 11.9 to negative 5. Industrial production month over month expected to fall negative 0.3%. Manufacturing production month over month expected to also fall 0.3%. And that is it for your week ahead economic calendar. That said, we are heading into seasonally the best 2 months of any election year. And considering all of the good news we have gotten recently, I think you're set up in kind of a perfect way for a larger market rally. Now, sure, I do think we are due for some consolidation, but I do think other areas will start to outperform and take the leadership, like biopharma, like small caps, like the Dow, right? Cyclicals, consumer, potentially staples will start to do a little bit better here, especially when some of the tariff policies come out and we realize it's not as bad. Like Dollar General has gotten hit recently off the tariff policies. Nike has gotten hit recently on the expected tariff policies. I believe when markets realize, hey, it's not as bad as we thought it was going to be, that's when you get the larger extent of the broadening out rally in our markets. But between now and then, as we get new information, I do think you will start to see that outperformance of the broad market compared to big tech. And that is what I am personally positioned for. That is what I have been positioning for. So maybe I'm biased here, but that makes the most sense to me in context of where the opportunity is over the next 6 to 12 months. Stocks like Tesla, for an example, could be a great example of this. A company that is not really going to be affected by tariffs at all because they've already structured their business in a way that you don't buy Chinese-made Teslas, right? You buy American-made Teslas. China buys China-made Teslas. Europe buys China-made Teslas to a certain extent. So a company like Tesla could benefit from all angles. Favorable government policies, 20-30% delivery growth expected next year, with longer-term growth, initiatives like robotaxis and Optimus that have enough optimism, enough expected growth to kind of fuel them higher even in the near term, in spite of what could be some kind of not correction, but consolidation for the broader markets. I don't think the broader markets here, the S&P or the NASDAQ, is going to start accurately reflecting what we see in the markets because of the weighting you get from big tech. If big tech underperforms, the rest of the markets could soar. And if you're an index investor in the S&P or the NASDAQ, you may not feel that nearly as much as a stock picker would. And that's kind of what I'm expecting in this upcoming week and over the next foreseeable couple of months. So let me know what you think about this information down below in the comment section. Have a fantastic rest of your day, and I will see you in the next one.